So here we are in the dreaded month of September. September since 1950 has been the worst performing month consistently. It's had more down months than it has up. There's several reasons for that. Typically traders take the summer off and they come back into the swing of things in September and look to reposition their portfolios. And a lot of fund companies end their fiscal year in September, and so they tend to tax loss harvest, if you will, in September. So that would be like our December. And so there tends to be a lot of rotation out of growth and into value. And with rates high, many traders will sit back and look at this and say, well, I'll just sidestep this volatility and go into something that pays me good, like bonds and other types of fixed income vehicles. So the question is, will we get a slump in September? Let's find out. My name is Brian Cannon, and welcome to Markets at 5. I'm going to show you a couple of charts as to why I don't think we need to worry too much yet about any sort of major pull down in September. However, there's always like always, there's mixed signs, some good, some bad. When we look at the S&P 500 here, you can see that there is still a negative divergence that's brewing. So we've got a rising stock price with a loss of momentum in the RSI, as well as we're starting to lose some momentum here in the MACD as well. But essentially, as of right now, everything is fine. So the RSI is still holding the 50. And again, anytime the RSI drops below 50, it usually spells trouble for the market. So you can see that it's come down and touched the 50 a couple of times here. But it's holding the line. Until that really breaks below 50, we're not really concerned. We're not going to do a lot of damage control. But we are seeing a rising wedge, which is typically a bearish signal. So when you've got a rising wedge, typically those usually break to the downside. But again, it's can be one of these things that it may or may not manifest, and it may take time as well. But we are watching this wedge, and so if we break down below this wedge, then that's kind of the first sign that we might be getting a little pullback here in September. And then we would want to watch very closely the 50-day moving average. We're going to want to make sure that the price action in the S&P holds at 50. So as long as that can happen, then we feel pretty good that we're going to continue this upward trend. All right, and when we look at this chart of the 40-week moving average, relative to the S&P 500, so the 40-week moving average is this line here. And so that you can see that any time that the stock market is above its 40-week moving average, generally it's heading the right direction. And when it's below its 40-week moving average, you can see that generally it's moving the wrong direction. And so right now we're well above that 40-week moving average. So there's no real concern at this point to proactively try to make any directional decisions on the S&P 500 right now. So again, when we look at the S&P on a weekly basis, it's above its 50 RSI, and MACD as well is trending positive as well. So right now we're not worried about this chart. This kind of just says everything's okay right now. So again, we can't preemptively predict any sort of a major drop. That's near impossible. But right now, this chart says that we're okay. And another chart here that also confirms that again, for right now, we're okay. So this is the 5-day moving average relative to the 100-day moving average on the S&P 500. So we've taken the S&P 500 out of the mix and just looking at those moving averages. And as you can see historically, when we have a breakdown of the 5-day below the 100-day moving average, again, it's another sign that the market's headed in the wrong direction. So as it stands right now, we've got the 100-day moving average is lipping up, which is good. It's trending up, and we've got the 5-day well above that. So it's starting to tail off a little bit here at the top. You can see. So we've got the 100 rising, and we get the kind of a stall in the 5-day moving average. So we want to watch that closely. It can turn, and when it does, we want to be prepared. Now, it could come down here and touch the 100-day and continue its trend upward. So again, we don't want to get too proactive on trying to make gut call decisions like that. But as long as that 5-day is above its 100-day, generally speaking, the market does what we want it to do. So between this and the 40-week moving average, I believe that we're in good shape right now. But again, as September does slump, we've got to we got to be prepared. Now, keep in mind the market generally prices rate cuts into the market before the Fed actually makes the rate. So sometimes it becomes one of those notions of, buy the rumor, sell the news. And so if the market's already priced in a rate cut and they don't cut rates quite as much as the market anticipates, it could lead to a sharp pullback. I do believe it's going to be result in a buying opportunity, but that's why we watch the charts to help make that determination. So in wrapping up, I think there's just so many things that can impact the market, especially in September. Macroeconomic type data such as jobs, inflation, the Fed funds decision to hold rates steady or cut rates, which I think will be dependent a lot on jobs. All of that will have impacts on the market and can create a lot of volatility. I think that it's going to end up resolving itself in a buying opportunity. So the important thing is just to watch your levels, and just be prepared that if it escalates, that you're ready. But otherwise, I think it's going to resolve itself as a buying opportunity. But if you have any questions, give me a shout, and I'll see you on the next Markets in 5.